Hello, this is Gary Schnitke, and this is a 5-minute Farm Doc Daily dealing with inflation and agricultural interest rates. Inflation has been in the news recently with rising inflation rates. Headline inflation is often used to measure inflation rates, and headline inflation equals the consumer price index for urban consumers less food and energy. Food and energy are excluded because those tend to vary a lot. Headline inflation was exceptionally low from 2010 to 2019 when it averaged 1.9%. Since that period, we've seen headline inflation increase, likely due to COVID and its responses, along with accommodative federal and monetary policies. That headline inflation reached 6.6% in September 2021 and now has decreased to 5.5% in February. A great deal of uncertainty exists about where inflation will go from this point forward. The Fed has a goal of 2%, where many people believe headline inflation and inflation rates in general will be higher than that because of shortages in labor markets. Whether or not inflation is at 2% or higher will have an impact on agricultural interest rates. Headline inflation will impact the overall interest rate in the economy, and that is often looked at by looking at the 10-year constant maturity treasury rate. Those rates have increased in recent time, but are still below inflation rates. That is unusual, and we expect through time 10-year CMT rates to be higher than inflation rates. 10-year rates have been below the inflation rates several times in the past, usually during periods of rising inflation. Over time, though, we would expect 10-year CMT rates to move back above inflation rates. From 2010 to 2019, CMT rates averaged 0.6% higher than headline inflation. That was an accommodative period, and another period which we will look at is from 2005 to 2007, when CMT were 2.2% higher than inflation rates. Agricultural loans tend to be above the 10-year CMT rate. It's above the 10-year CMT rate because risk in agricultural lending and cost associated with making loans to farmers. Over time, from 2003 to 2023, agricultural lending rates on operating notes have averaged 3.2% higher than the 10-year CMT rate. Using those traditional relationships, we forecast agricultural interest rates on operating notes given different inflation rates. If the Fed gets to its goal of 2% inflation rates, we would expect agricultural operating loans to be between 6% to 7.8%. Note that these are roughly equal to what rates are currently, and if the Fed gets inflation rates back down, we don't really expect interest rates on agricultural loans to come down. That's because historical relationships are out of balance right now. If the Fed does not obtain its goal and inflation rates average 3.5%, we would expect agricultural operating notes to have rates between 7.5 to 9.1%. If inflation rates continue at 5%, roughly what they were at the end of February, we would expect to see agricultural operating notes to have a 9% to 10.6% rate. All those rates, when we have higher inflation rates, are above those that are prevalent today, and we will see where inflation goes in the future. You can read more about this in the Farm Doc Daily, linked to the video description.